Imagine a machine so flawlessly engineered, so beautifully designed that it essentially prints money out of thin air. For an entire decade, the architects behind this marvel weren't just respected, they were hailed as absolute financial geniuses. I mean, they had cracked the ultimate code of modern business. They created this foolproof model that generated almost infinite wealth, completely bypassing the traditional, sluggish friction of doing things the old-fashioned way. Wall Street was cheering, investors were pouring in cash by the truckload, and executives, well, they were taking home massive, eye-watering bonuses. But deep inside the gears of this brilliant invention, there was a tiny, completely invisible timer ticking down to zero. And when that timer finally went off, it didn't just break the machine. No, it triggered a catastrophic event so incredibly bizarre, so publicly humiliating, and honestly so terrifying that it nearly brought an entire nation's financial system to its knees. We're talking about a disaster that nobody saw coming.
Now, to really grasp the mystery of what went so horribly wrong, we first have to understand the sheer genius of what went right. Think about how a traditional bank actually works, right? It's a very ancient, very slow business model. You take your savings to the local branch, you deposit your money, and the bank pays you a tiny bit of interest. Then, the bank takes your hard-earned cash and lends it out to, say, your neighbor who wants to buy a house, charging them a slightly higher interest rate. The bank pockets the difference. It's incredibly stable, sure, but man, is it slow. Because to give out more mortgages, you constantly have to convince more and more everyday people to walk through your doors and deposit their cash. But what if you could just bypass that entire bottleneck? What if a bank didn't actually need its depositors' money to give out mortgages?
Well, by finding a massive loophole to that ancient rule, our mystery bank achieved explosive, totally unprecedented growth. But there was a catch. This brilliant hyper-modern innovation eventually led to a massive street-level disaster. I'm talking about a terrifying physical panic that hadn't been seen since the days of top hats and horse-drawn carriages. It resulted in history's most expensive, shocking, and frankly desperate queue of ordinary people just trying to get their life savings back. Okay, let's dive into this explainer and see exactly how a financial miracle became a financial nightmare.
Part 1. The perfect money machine.
Our story centers on a company called Northern Rock. Now, for decades, Northern Rock was just a quiet, super respectable building society based up in Newcastle upon Tyne in the UK. It was a mutual institution, meaning it was owned by its members, mostly just helping local folks buy local homes. Nothing flashy at all. But in the late 1990s, the management team looked at the slow, steady growth of traditional banking and basically said, we want more. They wanted to play in the absolute big leagues. So in 1997, Northern Rock made a massive pivot. They demutualized. They transformed from a member-owned society into a publicly traded bank floated on the London Stock Exchange. And this single aggressive move gave them the keys to the vast, swirling oceans of global capital markets. The transformation was just meteoric. Back in 1998, their total assets sat at a respectable £17.4 billion. By the summer of 2007, under the fiercely aggressive leadership of CEO Adam Applegarth, those assets had absolutely exploded to a staggering £113.5 billion. They transformed into the fifth largest mortgage lender in the UK, a literal FTSE 100 titan.
So how did they pull off this insane growth? Well, they built what the finance world calls an originate and distribute model. Instead of sitting around waiting for grandmas and grandpas to deposit their pension savings, Northern Rock went straight to the global money markets to borrow massive amounts of short-term cash. They'd immediately take that cash and issue long-term 25-year mortgages to homebuyers. Next, they'd bundle thousands of those mortgages together into incredibly complex financial products. Using a securitization program they very fittingly named Granite, and they sold those securities to global investors. With the fresh cash from those investors, they paid off their initial short-term borrowing, skimmed a hefty profit off the top, and just repeated the cycle. It was basically a perpetual motion machine for creating mortgages without ever needing actual retail depositors. To everyone watching, it seemed like pure, unadulterated financial magic.
Section 2. A hidden fatal flaw.
Now, what's really interesting about this slide is exactly where Northern Rock was getting its lifeblood. A conventional bank of this massive size usually relies on sticky, super reliable retail deposits for about 50 to 70% of its total funding. But look at Northern Rock's 2007 profile. Retail deposits made up a measly 23%. The rest? A massive 77% of the bank's entire existence relied on securitization, covered bonds, and short-term wholesale money markets. Think about that. They were fundamentally entirely reliant on the kindness of strangers in the global financial system to roll over their debt every few weeks, or in some cases, literally every few days.
So the absolutely crucial point here is understanding the fatal trap they had basically built for themselves. Northern Rock was borrowing short-term cash to fund long-term, 25-year mortgages. Because they only had 23% retail deposits to fall back on, their basic day-to-day survival required the global interbank market to remain open and highly active every single day. If global investors ever got spooked, even a little bit, and stopped buying their securitized mortgages, or if other banks suddenly refused to lend them short-term cash, Northern Rock wouldn't just slow down. No, they would be instantly, violently starved of cash. They would default. And the crazy part? This would happen not because their mortgages were going bad, the loans were actually fine, but simply because the global music had stopped and they didn't have a chair to sit on.
Part 3. The day liquidity died.
Unfortunately for Northern Rock, 3,000 miles away, that music was about to come to a screeching, horrific halt. In the summer of 2007, an invisible global catalyst began to completely freeze the gears of their perfect money machine. You see, the U.S. housing market was starting to severely crack. Subprime mortgages in America were defaulting left and right, and those toxic assets had been bundled up and sold into global securities. By July 2007, 2 U.S. hedge funds at Bear Stearns had totally collapsed under the weight of these bad loans. Then, on August 9th, the French banking giant BNP Paribas suddenly froze 3 of its investment funds, explicitly stating there was a, quote, complete evaporation of liquidity. Absolute panic struck the global system. Banks suddenly had absolutely no idea which of their competitors was secretly holding this toxic American debt. So what did they do? They did the only rational thing. They stopped lending money to anyone. The interbank market froze solid. The LIBOR interest rate spiked massively overnight. And Northern Rock, completely out of nowhere, found itself totally cut off from the wholesale cash it desperately needed to survive.
To truly appreciate the gravity of what was happening here, we actually have to pause and look backwards in time. Before 2007, the United Kingdom had not experienced a true physical bank run in 141 years. The last time it happened was all the way back in May 1866, with the collapse of the major discount house Overend, Gurney. Back then, terrible lending practices and suddenly frozen markets led to the firm slamming its doors shut, which sparked a devastating physical panic right in the streets of London as people realized, to their horror, that their money was just gone.
They say history doesn't repeat itself, but man, it really does rhyme. Back in 1866, the Bank of England refused to bail out Overend Gurney because they were fundamentally insolvent. But that resulting street panic inspired a guy named Walter Bajot to write what became the golden rule of central banking. The central bank must act as the lender of last resort, lending freely to solvent banks that are just facing temporary liquidity crises. Now flash forward 141 years to the digital age of 2007, Northern Rock was facing the exact same ancient terror. Behind the scenes, absolutely desperate and completely out of cash, they secretly invoked Bajot's rule, going to the Bank of England and begging for an emergency lifeline.
Section 4. The historic bank run.
The grand plan was to secure this emergency central bank funding very quietly, restructure the business over time, and above all else, avoid spooking the general public. It was this incredibly delicate, high-wire act of financial diplomacy. But look, in the age of 24-hour news cycles and the internet, keeping a multi-billion-pound secret is virtually impossible. The trapdoor was about to swing wide open. On the evening of September 13, 2007, the BBC's business editor Robert Peston went on national television and dropped an absolute bombshell. He reported to the entire country that Northern Rock had been forced to seek emergency financial support from the Bank of England. The secret was out. Millions of viewers sitting peacefully in their living rooms suddenly realized that the bank holding their entire life savings was effectively on life support. Containment was instantly, completely impossible.
What happened the very next morning wasn't driven by stupidity or irrational fear. It was driven by cold, brutal, game-theoretic logic. See, at the time in the UK, deposit insurance only fully covered your first £2,000. It covered 90% of the next £33,000, but anything over £35,000, that was completely exposed to a severe risk of total loss. Think about it. If you wait at home, trust the bank, and the bank actually fails, you lose your life savings. But if you queue up, withdraw your money, and the bank ends up surviving, well, you just wasted a few hours on a chilly morning. The cost of queuing is literally nothing. The cost of not queuing is everything. That completely rational logic is exactly what drove thousands of ordinary people, armed with folding lawn chairs and thermoses of hot tea, to line up around city blocks at the crack of dawn.
When the branch stores finally opened on September 14, the sheer scale of the panic was breathtaking. It was unprecedented. In a single chaotic day, panic savers withdrew a shocking £1 billion from Northern Rock branches. $1 billion. And of course, television cameras were broadcasting these massive lines globally, which just acted like gasoline on a fire, fueling even more panic.
And the digital systems? They fared absolutely no better. The bank's website completely crashed under the insane surge of traffic. Phone lines were totally jammed as customers desperately tried to wire their money to literally anywhere else. Over just a few chaotic days, the total hemorrhage reached a staggering £4.6 billion. The bank was just bleeding out in plain sight, and as you'd expect, their stock price plunged 30% in a matter of hours.
Meanwhile, behind closed doors, policymakers were caught in this brutal, unwinnable dilemma. Bank of England Governor Mervyn King was deeply concerned about a concept economists call moral hazard. If the government swoops in and generously bails out a bank that took massive, frankly reckless risks with its funding model, what message does that send to Wall Street and the City of London? It basically tells every other bank that they can take wild, unhedged gambles, keep all the massive profits when times are good, and just let the taxpayer foot the bill when the whole thing explodes. It practically invites future disaster. But as the queues on the streets grew longer and more desperate by the hour, theoretical economics crashed headfirst into political reality.
Part 5. Bailout and the Aftermath. The panic was seriously threatening to spread. Shares in other major banks were already starting to slide. If the general public lost faith in the entire banking system, the economic damage wouldn't just be bad, it would be incalculable. The government absolutely had to step in to stop the immediate bleeding, even though doing so would drag them into a financial nightmare that would last for years. So on September 17, 2007, Chancellor of the Exchequer Alistair Darling stepped up to the microphones and made a drastic, unprecedented announcement. The UK government would unconditionally guarantee all existing deposits held at Northern Rock, not just the first £35,000, but every single penny. And you know what? It worked. That massive blanket guarantee broke the fever of the game theory. The queues slowly dispersed, effectively ending Britain's first bank run in a century and a half. But here's the crazy part. The bank's underlying business model was still completely broken. With the global wholesale market still frozen solid, Northern Rock literally couldn't function. After months of desperately trying to find a private buyer to take this mess off their hands, the UK government was forced to fully nationalize Northern Rock in February 2008. At its absolute peak, the staggering taxpayer exposure required to prop up this entire system through loans, guarantees, and capital injections exceeded £100 billion. Let that sink in. The perfect money machine had officially become the ultimate public burden.
And this brilliantly illustrates exactly why the collapse of Northern Rock changed the world of finance forever. This localized UK disaster forced a massive, sweeping rewrite of global banking regulations. To stop the game theory panic from ever happening again, deposit insurance in the UK was eventually hiked up to £85,000. The government also created a special resolution regime, giving them the legal framework to safely wind down failing banks without causing mass chaos. But most importantly, on a global scale, the Basel III framework introduced incredibly strict new rules, like the liquidity coverage ratio and the net stable funding ratio. Basically, banks were finally forced by international law to actually hold enough high-quality liquid assets to survive a 30-day market freeze, completely ending the Wild West days of those originate and distribute extremes.
Now, if you take away just one core lesson from this entire explainer, it has to be the fundamental, absolutely critical difference between solvency and liquidity. At the exact moment those massive, desperate queues formed on the streets, Northern Rock was actually, technically speaking, solvent. Their underlying mortgages were performing just fine. Their long-term assets exceeded their liabilities. But they were fatally illiquid. They simply did not have the physical cash on hand to pay their daily debts the moment the wholesale markets closed their doors. Think of it like this. You can have $1 billion locked inside a giant vault, but if you can't open that vault today to pay the cab driver, you are effectively bankrupt.
In the end, Northern Rock didn't cause the 2008 global financial crisis, but it was the perfect, terrifying preview of what was about to come. Chancellor Alistair Darling later wrote, and I quote, "Northern Rock was the warning that the financial system chose not to hear. The wholesale funding model was visibly, structurally broken, but the financial world just hit snooze on the alarm." Exactly 1 year after those queues formed in Newcastle, Lehman Brothers, operating on much the same dangerous wholesale dependency, would utterly collapse, plunging the entire globe into the Great Recession.
So the real question we have to ask ourselves today, as banks continue to innovate and seek out fancy new ways to print money faster, is simple. Are we truly safer today, or are we all just waiting for the next invisible timer to go off?